Go ahead and start the recording now. And we're going to pick up now talking about how to look at the adjustment of our assets up to fair value, right? Because when we acquire them, we consider this an arm's length transaction, acquisition, and so we'll bring them on at their fair value. Now, when we look at this, there's going to be really two chunks to this, okay, which is the write-up of our tangible assets and then a write-up of our intangible assets, excluding goodwill. Remember, goodwill is whatever is left as the difference between the acquisition price and the amount that is assigned to intangible assets first, tangible assets first, then intangible, and then any remaining amount goes to goodwill. Okay, so let's just go ahead and that's basically what we're saying here. And you can go ahead and flashcard that order, okay, which is what we're going to write up the assets to their fair value. We will write up any intangible assets, and then any excess goes to goodwill. Now, if there is an amount of the fair value of the assets that is more than the acquisition price, we'll recognize a gain for that. You know, again, that's not very realistic. You know, I think that's very rare that that could happen. And I don't want to bring up a horrible tragedy as an example, but let's say there was some sort of accident or something with our equipment that, you know, injured some folks. Maybe there's a situation where you could acquire the assets that caused the accident for less than their fair value. But, you know, I find that, you know, somewhat of an unusual kind of thing that would happen. Okay, good. So let's go ahead then and let's talk about those first two steps. And we're going to have the acquisition with goodwill here. And we're first going to do what? We're going to acquire 100% in this particular example. And we're going to, well, I don't know if it's 100% in this example, but we're going to go ahead and assign 100% of the fair value to first the balance sheet assets to fair value. Those are your tangible assets. Then any specifically identifiable intangible assets, and you see some of those listed. And then we'll see that any remaining amount will go to goodwill, which is the step 3 that we've already talked about up here. Okay, so let's just go ahead and let's talk about now the intangibles. Okay, examples of specifically identifiable intangibles, things like what? Patents, copyrights, franchises, those sort of things. In process research and development that we're going to talk about here in a minute is kind of interesting, because what we learned back, whatever it was, chapter 2, I guess, that research and development is what? Expensed. Research and development costs are expensed. But if there is in progress research and development, we would assign a portion of the acquisition cost to that in progress research and development. In some cases, maybe the acquisition of the company is being made because the main thing that the acquirer is interested in is the in progress research and development. And so we would assign a value to that when we're preparing the consolidation. Okay, so let's go ahead and let's take a look, and we say that we should recognize an intangible asset separately from goodwill at the acquisition date. If we're talking here, guys, about in progress research and development. Okay, do not write it off. In process research and development meets the definition of the asset if it has probable future economic benefit. And again, I'm basically saying in many cases that's the reason for the acquisition, that they want to get that in progress research and development. Okay, now if it is a finite thing like a patent or something, then amortize it over its remaining life. If it has an indefinite life, we do not amortize, but we will need to evaluate it for impairment using the one-step method that we'll talk about later. Now, when we get into impairment, okay, when we're dealing with impairment and it has a finite life, let's start with that. Okay, the useful life is limited, we will amortize it. Okay, over the economic life. And when we look at the impairment, we will take the two-step approach, and we talked about that at the end of chapter 3, which is we look at the cash flows undiscounted, right? If the undiscounted cash flows are more than the carrying value, now in this case of the intangible asset, we will not go any further for the impairment. If the undiscounted cash flows are less than the carrying value of the asset, we have impairment, and then we will discount those cash flows to calculate the amount of impairment, et cetera, like we talked about. If it is basically an indefinite life, and indefinite life for assets that we don't know how long their life is, and goodwill is an example of one that has an indefinite life, even though it's not specifically identifiable, it has an indefinite life. You could have intangibles that have an indefinite life that are specifically identifiable. For example, a franchise. You don't know how long, McDonald's is going to be considered, something that has value to it. And so if that's the case, it would have an indefinite life. You don't know, so you don't amortize it, but you will evaluate for impairment using the one-step method, and we'll talk about that later in this chapter. I think it's module 8. We'll get to that, and that's also that would be applied to the goodwill amortization. Okay, and then after you have taken any of that acquisition price attributed to the fair value of the tangible assets, fair value of specifically identifiable intangible assets, finally you go to what? Finally, any remaining amount goes to goodwill. Okay, so the goodwill is always going to be the difference between the fair value of the subsidiary, which is what you would have paid for that subsidiary, versus the fair value of the subsidiary's net assets, again, going in that order that we have talked about. Okay, so goodwill is less. Okay, now goodwill is not amortized, but it will be what? It will be evaluated for impairment. And as I've said, we're going to get to that here a little bit later. And we would do that using that one-step method. And it is written down and charged against income, is shown as an expense on the income statement. Okay, so flashcard that, because there was a time when goodwill was amortized, and so that's maybe still rattling around in some folks' mind that you would amortize goodwill. You do not. You do not amortize goodwill. You simply evaluate it for impairment using that one-step method. Okay. Okay, good. So let's go ahead then and let's take a look at an example where we will go through that process of determining the fair value, determining the amount of goodwill, et cetera. And we've really kind of already looked a little bit at something like this, but let's get a little extra batting practice here, which is they tell us that they paid $75 million for the fair value of the net assets of TAG purchase Garrity. Okay, and so we would take that 75 million. I just want you to get used to this, guys. We would divide it by what? 0.60. That means that the fair value of the entire company is this 125 million. Okay, fair market value of the entire company. Okay, non-controlling interest then becomes what? The 40% of that. And the goodwill is the difference between the entire fair value versus what the fair value of all their assets were. And they tell us that the fair value of the net identifiable assets, okay, in other words, intangibles and fixed assets, but not goodwill, okay, is what? Is 60 million. So the difference between the fair value of the company and the fair value of all the identifiable, that's both the fixed assets, et cetera, and the intangible assets that are specifically identifiable, not goodwill, that difference then does become the goodwill of 65 million. Okay. So we go ahead and we start to take a look now, and they tell us that the carrying amount of the net assets is 50 million. So we're going to have what, a $10 million write-up there. So again, you go ahead and you piece these journal entries together, guys. You see that we know we would have what, and the way I do these is I first get rid of the investment. I know I always have to get rid of whatever they paid for that. I know, and I'm just putting these numbers here to have the entry, the order that I would go in for the journal entries. I know I will always get rid of the entire book value, the entire stockholders' equity. That question didn't break it out as to how much was common stock, how much was APIC, how much was retained earnings, but I know I have to always get rid of that entirely. The beginning of the year when I initially make the investment, at the end of the year. I know I always have to do that. And then I have to do what? Bring the assets up to their fair value at the date of acquisition, by the way. Don't get tricked into saying at December 31st, the assets had this fair value, and then you're trying to adjust it to that fair value at that date. No, it's at the date of acquisition, okay? I showed you how to calculate the non-controlling interest, which was essentially the fair value of the company times whatever the non-controlling interest piece was, and then goodwill would be the fifth part of that. But of course, I don't want to make a whole journal entry if the question asks me, what's the goodwill? So it's simply what? It's simply the difference between the fair market value of the entity and whatever we had as the fair market value of all the other assets. This right here. Okay. Okay, good. So let's come over. And again, I don't know that we need to keep belaboring the car and big mnemonic over and over again, okay? And let's see what happens if we acquire an entity and we acquire an entity with a gain. Now, again, guys, I think that this is highly, highly unlikely that something like this would happen, but standards and textbooks, therefore, tend to talk about all possibilities, and so maybe you'll get one question that asks how this should be done. Okay, so again, we take all of the fair value to the specifically identifiable the fixed assets, the tangible fixed assets, then the specifically identifiable intangible assets, patents and whatnot. And if there is an amount that is left over that basically, for those fair value of those assets that is more than what we paid for it, that difference is considered a gain. Okay. And again, highly unlikely, in case of flashcard, that difference would be a gain. Okay. But highly unlikely that this would ever happen, but let's just look at it. They purchased 100% for $1 million. Net book value is 800,000. Fair value is 1.2 million. And you're looking at that saying, well, how? I don't know. Somehow, for some reason, they were able to acquire assets that had a fair value of 1.2 for only $1 million. Okay, nice work if you can get it. But doesn't happen a lot. Okay, so what happens? You come over, and when you look at that eliminating entry, let's just go down to the journal entry here. We don't need to keep doing that scale. But you come over, you always get rid of the entire book value of the company. It's common stock, it's APIC, it's retained earnings. I know you're getting tired of hearing that. You get rid of the investment. Okay, you go ahead, you write up the balance sheet items, the specific identifiable items up to which you determine their fair value to be. And since you acquired assets that had a fair value of 1.2 million for only $1 million, well, I guess you got a gain here. Now the G in big stands for gain instead of goodwill. They used to call it bad will, but I guess they figured, okay, that's kind of not the best way to articulate that. So now they call it a gain, and that's reported on the income statement. Okay. Maybe we should put that up. Reported as a gain, where? It's the gains on the income statement. Okay, good. Now let's come over and let's take a look at a couple of multiple choice questions. Oops, after we look at this measurement period adjustment, sorry. What happens? There could be some changes in some of the values of some of these things as we go along. And so we will need to make certain adjustments for those, okay? So the value assigned to the assets, liabilities of subsidiary are always not known for certainty at the acquisition date. When this is the case, the recorded amount on the acquisition date are provisional and may be adjusted during the measurement period, okay? So the measurement period cannot exceed 1 year and ends when improved information is available or becomes obvious that no better information will be available. Flashcard those phrases because I could see CPA exam questions asking you something like that. You know, as to when the measurement period, how long it goes on, cannot exceed 1 year and ends when you feel there's no better information. But you take a look at this example, guys, and they give us the book value of things. They give us some fair value of these different things. And you take a look and just to make sure that we're comfortable with what the, you know, amounts here that they're showing us total up to. Yeah, I calculated this earlier, and I think this one, let me do it again. Doesn't hurt, I guess, to make sure. Okay, so we look at the calculator here, and we've got what, 100,000 of fair value plus what for the current assets plus 25,000. They tell us that the property, plant, equipment has a fair value of 250,000, and the in-process R&D has a value of 100,000, and then the liabilities have what, 50,000. So we subtract 100,000 plus 25,000. Plus 250 plus the 100,000 minus the 50,000. Anybody got a number for me there? Because I obviously can't use my calculator. 100,000 plus 25 plus 250 plus 100 minus 50 is how much?
425.
Thank you. Okay, and then can somebody help me to add these numbers up because I can't talk and add at the same time. 100 plus 25 plus 260 plus 75 minus 50 gives you what?
435.
That doesn't sound right. Is that right? 35.
410.
Huh?
410.
Okay, can I get another number here?
Is it 410?
Huh?
Is it 410?
Plus 75,000.
Yeah, I got 410 also.
Minus, okay. I never did get it right on my calculator. What's that last number? For what?
10.
Okay. Okay, good. Now we come over and we take a look and we calculate the goodwill recognized on July 1st based on those provisional values. Okay, so what happens? We paid, and they told us in the problem that we paid 500,000 the fact pattern. And since we got stuff that had provisional fair value of what? 425, that means that we have goodwill of 75,000. Okay. Now we go ahead and we set that up, but then based on the final, the goodwill should be 90,000 because it's what? It's the 500,000 minus the amounts that I could never get right on the calculator that you calculated for me of the 410. So then it changes to 90,000. So initially we do what? Of course, we always get rid of all of the subsidiaries' book values. And in that case, they had given those to us, the book value of the common stock, additional paid in capital, retained earnings. We always get rid of those, right? Then we go ahead, we eliminate the investment. We write up the property, plant, and equipment. It went up the 50,000, right? The difference between the 200 and the 250. So we wrote that up initially, the 50,000. Okay, we brought on those intangible assets, the in-process research and development, which doesn't have value on the subsidiaries, but when we buy it, we maybe bought the company for that research, so we bring that on, and then we already calculated that that difference is goodwill. Okay, then what? Then a little bit later, since the in-process, when we have the finals, the in-process R&D came down 25,000. So we write that down to 25,000, and we saw that the goodwill, well, let's just look at the property, plant, and equipment. Okay, the property, plant, and equipment went from the 250 to the 260. So we write that up. Okay, and then we saw that now, because the goodwill had to go up from 75 to 90, we write up the goodwill. Okay. Okay, good. I don't know that the exam is going to get all off into provisional versus final amounts, but there it is. Okay. All right, good. Let's go ahead then and let's take a look at a couple multiple choice questions. Guys, we're coming up on the 2 minutes, but I'll give you a little bit more time if you need that. Okay, looks like everybody's got a chance on that. So I'm going to go ahead and end the poll here and share the results. And good. I mean, we got 100% on this, and this is you know, I'm telling you, you're going to see questions like this. So this is very good. Okay, so let's go ahead though, and let's take a look at this one together. No, everyone got it right, so it's obvious you understand it. But you have to do everything at fair value, right? And what's interesting about this question, what helps with this question is they've acquired all of the outstanding common stock. So it's not like we have to figure out, well, what did they pay and how much is the total value of the company versus the minority they used to call it minority interest, the non-controlling interest, et cetera. Okay, so we know that they paid 860,000 per the fact pattern. Okay, and they got at fair value what? They got assets that had fair value of 840, right? That's the assets, and liabilities, okay, they have fair value at 140. So what do? You say, well, we went ahead and we got book value here of fair value, excuse me, of 840 of assets minus 140 of liabilities, means at fair value we acquired what? We acquired 700,000, but we paid 860. Well, that remaining amount, since they don't talk about, you know, any other items like intangibles or anything, that difference, I should say, the remaining amount has to go to what? To the goodwill. Okay. Okay, good. Very good. Let's try another one. Okay, guys, I'm giving a little bit more time on this one. We've got one person still sort of working on it, so I'll give you a little more time. Okay, good. All right, we did okay on this one. Not as good as some of the other ones that we've been looking at. So we got 60%. I'm a little confused why some folks wanted C. We have 4 folks picking C, so maybe you guys can enlighten me as to what you're seeing there. But let's just look at this. Let me start by asking you a question. Is fair value what you pay for something? Is that a fair value? Is fair value what you pay for something?
Yes.
Right. The assumption in accounting is you never pay anything other than what the fair value is. Once you determine that you're going to pay a certain amount for something, that becomes the fair value. Okay, in accounting, we assume that no one's getting took. Okay, so what happens? We're sitting there and they paid what? They paid 12 million. This Riggs, I guess. Paid 12 million, and that constituted 75% of what? 75% of the fair value of the entire company, didn't it? I mean, if Riggs paid 75% of, paid 12 million, I should say, to acquire 75% of the fair value, then the fair value times 75% has to equal 12 million. If we take the 12 million and we divide it by what? 0.75, I believe, if I'm doing my math right, we get 16 million is then the fair market value of the company.
Yes, correct.
Okay, and they want us to calculate what? The goodwill that they're going to report on the consolidated balance sheet. By the way, guys, notice these questions are saying reporting goodwill, and you report goodwill when you consolidate. You don't report goodwill if you're not consolidating, although a question may ask you what's the implied or the goodwill, that's, but if they say reported, then the answer would be 0 under the equity method. When we consolidate, yes, we will report that goodwill. So they tell us that what? The assets have fair value of 13. So we paid 16, we paid, how am I trying to say this? The goodwill that's implied here is what? Is the 3 million. Okay, that's the goodwill that's associated with this acquisition. We'll write all the assets up to their full amount. We take all the assets. We don't go through and multiply. Maybe that's where the 2,250,000 came from. What were you doing? Multiplying this 3 million number by 75%? Is that what you did?
Yeah, that's correct.
Okay, that's how you got the C. Okay, no, you take the full amount of everything. We will have a subtract, remember, in the stockholders' equity section for what? For the non-controlling interest share of things. You show 100% of everything, and then you show the subtract. You write the assets up entirely to this additional, whatever it is, that they have to be written up 2 million, and you write the goodwill up the full 3 million. Okay. Question? Okay, good. Notice, guys, that, if it's 100% situation, the question's a little easier, which is what happened there. You just take whatever they tell you, the fair value of the assets minus the fair value of the liabilities. That's the fair value of the book value. Compare that to the 100% acquisition cost that you paid. If you're dealing with a problem where it's less than 100%, you have to do this additional maneuver here. Okay, good. Let's go over and let's take a look at intercompany questions. Okay, intercompany considerations. And when you have intercompany transaction, guys, the operative word is eliminate. Eliminate intercompany transactions. Okay, and you can flashcard these simple eliminating entries, and on the exam, if you were being asked to do a full consolidation, this would be beautiful. You'd be, oh boy, isn't this fun? By the way, I want to say something about consolidations. I hear students say, I see it on the Facebook for FAR, which I don't advise joining because it's a lot of silliness in my opinion. Like I saw one the other day, somebody says, anybody want to study right now? And they're going to have one of these, when they call that pop-up study situations. And I'm just like, just study. Stop bothering other people about trying to study with you. Okay, but anyway, So I don't like it for many reasons, but I spy on it every now and then because I guess I'm a CPA exam teacher geek. Okay. But, I hear a lot of sad talk about consolidations. Don't get into that trap. Go through and think of this as something fun that you're looking at, and you're doing the things that are part of this that you're good at. If there's something in this that you're struggling with, so effing what? Okay. You don't have to be perfect on this. We're trying to get a 75. Have fun with the easy pieces of this, and then do your best you can with the not as easy parts. Okay. But this stuff is easy. If you have an intercompany receivable and payable, eliminate it. Okay. By debiting the payable, crediting the receivable. Intercompany bonds, eliminate. Debit the bond payable, credit the bond investment. If it's an interest that's payable, debit the payable, credit the receivable. Dividend, debit the payable, credit the receivable. Okay, easy stuff. Okay, now you come over and they talk about income statement eliminations. Okay, so let's just go ahead and let's take a look at some of those and what happens when we have intercompany merchandise transactions. Now, these get a little bit funky, I guess, for lack of a better word, in that when you have intercompany transactions, you're going to have to eliminate any profit that may be contained in the cost of goods sold or inventory of the purchaser. Okay, and that gets a little bit more involved, but let's just go ahead and take a look. And if a common or affiliated companies sell to one another, often this inventory merchandise is sold at a profit. The total amount of intercompany sale and cost of goods cost of goods sold should be eliminated prior to preparing the consolidated financial statements. That's easy. You're always going to have to get rid of that. In addition, okay, the intercompany profit must be eliminated from the ending inventory and/or the cost of goods sold. The reason I say and/or, if they sold all the goods, then you just have to eliminate it from the cost of goods sold. If they didn't sell any, then it would all be eliminated from the inventory. But if they sold some and they still have some, the purchasers still have some in ending inventory, then you have to allocate that intercompany profit. Okay. But the 100% of the profit should be eliminated, even if the parentship ownership interest is less than 100%. Okay. Flashcard that part, because remember, we show 100% of the sales and we show 100% of the expenses, and then the amount of income that's attributable to the non-controlling interest will be a calculation after we have figured out the total net income of the company. Okay, now go ahead and flashcard this sort of example of an entry with no numbers, but you always get rid of all of the intercompany sales, 100%. Okay, you get rid of what? You get rid of all of the cost of goods sold, the intercompany cost of goods sold, 100%. Okay, and then if there is any retained earnings, any items left, you'd get rid of the intercompany profit in the ending inventory, and you'd get rid of the intercompany profit included in the cost of goods sold. And we're going to look at an example of that in a minute. That's for the year of purchase. Okay, and then any profit in retained earnings would have to be eliminated if we've had some sort of profit that we've taken in a previous year. Typically, though, it's going to be these items that we've seen here that we will be dealing with. So you come over and you take a look. I guess that's probably a decent flash card, because that's sort of going to be the main takeaway of this example that we have down here. Okay, because a lot of this stuff is easy, but we have 100% ownership. Inventory cost $1 million. They sell it to the subsidiary for 1.1 million. The year one ending inventory of Alinto included cost of goods purchased from Alinto of 660,000. Alinto had remaining account balance of 200,000 that he owed Garrity. And so let's go ahead and take a look at some of these eliminating entries. Now, first, we have the entry to record the sale. Okay, on Garrity's books, debit accounts receivable, credit the intercompany sales, debit the intercompany cost of goods sold, and credit the inventory. Okay, now on Alinto's books, Alinto would have recorded that inventory and credited the accounts receivable. Now, let's look at the accounts receivable first, okay, because I want to do the easiest thing first. They told us that there was still what? 200,000 that was outstanding. Well, we know, and again, CPA exam, easy point counts just as much as a hard point. Okay, so what do? We eliminate the intercompany payable receivable. Easy enough. Okay, next easy thing that we're going to do is get rid of the entire intercompany sale. Get rid of what? The entire intercompany cost of goods sold. Now that leaves us 100,000 of profit, and that 100,000 of profit is going to be what? Is going to be contained in, again, it could have all gone to cost of goods sold, could all still be in inventory, but typically they sold some of it, but they still have some of it. So you have to eliminate some from the cost of goods sold and some from the ending inventory. Okay, so when you look at the problem, they told us that what? There was still 660 of stuff that they bought for what? That they bought for 1,100,000. So if you look at that, you say, well, okay, we've got what? We've got this 660,000 of stuff that's left that we bought for what? 1,100,000. So that means that what? 60% of the intercompany profit, okay, which is right there, is sitting in my cost of goods, in my ending inventory, and the difference, 40%, is sitting in my cost of goods sold. So I go ahead, and when I take that that 60% and that 40%, okay, which is right there, times the intercompany profit, that's the adjustment to the cost of goods sold. That's the adjustment to the ending inventory. And I go ahead and I make that adjustment appropriately here. I credit the cost of goods sold to take out the profit, that's intercompany profit that's sitting in cost of goods sold. And I take out the 60% of the intercompany profit that's sitting in inventory. Okay. Yeah, I think you got some good flashcards on that. Okay. Question, and you can see that example. Okay, good. Now you come over, and if we have intercompany bond transactions, okay, we will need to recognize their gain or loss on what is considered extinguishment of debt if there's a difference between whatever the carrying amount of the bond payable is and what the amount is that it was acquired for by the acquiring company. So let's just go ahead and let's take a look at that. And we have the situation where they bought, they issued some bonds, I should say, for cash. The face amount of the bond was $250. So we have a premium of $50,000. Now, for some reason, the next day, or the same day, okay, somebody came up, the subsidiary came up and said, I'll give you $275,000 for those bonds that have, you know, that you just issued, you know, that somebody else just bought for 300,000. Now, why the person that just bought those for 300,000 would immediately be willing to sell them for 275,000 is highly unrealistic, right? You just bought a bond for 300,000, and then you turn around the next day and you sell it to the subsidiary of the person you just bought it from for 275. I mean, that would be kind of thuggish if something like that happened, but let's just go ahead and understand, because they didn't want to get into amortizing the premium or any of that. Okay. And so they just wanted to make this as simple as possible so that you understand that now when we go ahead and we consolidate, we get rid of the bond payable, we get rid of the premium, we would get rid of the investment. And since the investment was at 275, but as a consolidated entity, we got to keep what? 300,000. And again, theoretically, this probably wouldn't happen, but they don't want to have to amortize the premium and stuff. This is considered what? A gain. So if the subsidiary buys the bond for less than its carrying amount, it's a gain. If they buy the bond for more than its carrying amount, then that would be a loss associated for the consolidated company. It's like extinguishing your debt for more or less than its face amount. That's all it comes down to. Okay. Okay, good. Now you come over and intercompany interest. Keyword is eliminate. Intercompany amortization. Eliminate the amortization. Okay, we don't have intercompany, interest revenue, interest expense. All right, good. Come over and let's just take a look at intercompany sale of land. Okay, and land is a little easier than what we're going to talk about in a minute when we're going to start to get into equipment. Land is easier because there's no depreciation on land. Equipment, we got to deal with the depreciation on that equipment. Okay, but let's just go ahead and take a look. And it's basically, we're going to reverse the entire transaction. So if you're sitting there and they had land that was being carried at 175 and they purchased it for cash of 200,000, then the seller of that land would, of course, record a gain of 25,000, and then the land would come on the purchaser's books at 200,000. But of course, unless you're, somebody like Enron or something, you can't sell stuff. Nobody should sell stuff to themselves at a gain. Okay, so what would we do? We would debit the intercompany gain, credit the land, as though the transaction never happened, because you can't sell stuff to yourself at a gain, right? And we're considering it one company. Now, if it is a depreciable asset, say fixed asset, like equipment, then you're going to have to go ahead. Oh, before we leave the land discussion, subsequent year thereafter, until the land is sold, retained earnings would be debited and land would be credited, because that gain will eventually be closed out to retained earnings. So then later you have to take that out of the retained earnings. Okay, so instead of debiting a gain that affects the income statement, you would just go ahead and try to point and do the debit to retained earnings instead. Okay, and flashcard that. So remember that it's after the first year. It's the same basic principle, but you debit the retained earnings instead of the gain. Okay, now here we sold equipment. Okay, equipment is a little different because it's depreciable, and they tell us that at the time of sale it has a 10-year life, and we're going to have to understand how the depreciation on that would affect the eliminating entry. So at the time of the sale, on the seller's books, we would debit the cash. The machine had original cost of 90, it had accumulated depreciation of 20, so they sold it for more than its book value of 70. We have a $30,000 gain. Then what? On the books of the purchaser, they bring it on what they purchased it, and then they would depreciate it, and they would depreciate it at the purchase amount with the 10-year life that's left, and they would take $10,000 of depreciation expense and credit the accumulated depreciation there in year one and the years thereafter. Now, the journal entry that needs to be made to eliminate that intercompany sale at a profit of the land, we would debit the gain, credit the machine for 10 to bring it back down to 9, and put that back in to the accumulated depreciation now, because we had eliminated before, but we got to put it back because we're going back to what it was for the combined company, right? Okay. Now what happens? Now we go ahead and we take a look at this, and we say, well, we have what? We have a different amount of depreciation that would have been taken over the remaining life if it had a book value of 70, which would have been 7,000, but we took what? We took 10,000 up there. That's a what? That's a difference of $3,000. So we have to take that out of depreciation expense and debit the accumulated depreciation for 3,000 to put it back where it belongs. Okay. Now, that's year one of a transaction like that. When we get into year two, okay, and let's just think about in year two what the retained earnings looks like. The retained earnings, okay, of the parent has what? Has $3,000 less in it, doesn't it? Because they took more depreciation. And the accumulated depreciation, which I'm going to abbreviate AD, has what? Has an excess 3,000 accumulated depreciation. Now, what happens when we go into that next year and we want to adjust things? We have to do what? We have to take out that intercompany profit. But what's happening now when we take out that intercompany profit, because we had the 30,000 that had been put into the retained earnings of the combined company for that intercompany profit, but we took excess depreciation of 3. So what's going to happen to put this back now where it should be, because we had that intercompany profit of 30, we're going to do what? Debit it for 27,000, which you see there. Now we remove the entire effect of the excess depreciation and the intercompany profit that was sitting in the retained earnings. What else? The accumulated depreciation, we had taken 20,000 out of the accumulated depreciation at the time that we had sold the property, but now we want to put it back. But we already have 3,000 as excess depreciation from year one. So to catch that up, we only need to put what? 17,000 as a credit to the accumulated depreciation to put it back where it belongs. And then, of course, we're going to bring the machine back. I'm not trying to strike that out. I'm trying to underline it. We're going to go ahead and put that back to the equipment account right here. Okay. And then we are going to, of course, take the adjust the depreciation back down 3,000, and that'll continue year after year as we depreciate that equipment over the next 10 years. Okay. Okay, good. Let's go ahead and let's take a look at a couple of class questions. Okay, looks like everybody's had a chance to try this one, and looks like just about everybody got this right. If you have intercompany receivables, they are what? Eliminated entirely. You don't show any amount that's left over. I don't care if you own less than 100% of the company or what. The entire intercompany receivable needs to be eliminated. So the intercompany receivable that we recorded is what? Is 0. Okay. Okay, good. That's a question, guys, that you get used to through repetition in your homework. You're going to see a bunch of those. You know, the examiners are thinking under a question like that, a candidate would waste a good, 20 minutes, not 20 minutes, a good, 2 minutes, whatever, to get the wrong answer. Meanwhile, it takes you 10 seconds to get the right answer. You don't report intercompany receivables. They are eliminated, and payables, they're eliminated. Okay, good. Let's take a look at this one. Okay, looks like most of us have had a chance to look at this one, and most of us got it right, 80% of us. This is something, again, that you sort of have to get used to dealing with, and, just sort of get comfortable with these questions, because it's easy to make the mistake. But just keep in mind, as we've said now several times, 100% of everything is shown on the income statement. Doesn't matter if you own 80%. Of course, obviously, if you own less than 50. But if you own 50% or more, you show 100% of everything on the income statement. And then the non-controlling interest adjustment is made down there, like I showed you earlier, at the bottom of the income statement. So the sales and cost of goods sold in their entirety should be eliminated by the amount of the intercompany sales. And then the only time you start getting into percentages is not based on, the percent that you own. No, it's based on what percent of the intercompany profit is in cost of goods sold versus ending inventory. So that's maybe where you got confused, because we did do some with percentages there. It was not based on percentage of ownership. If it's 100%, you take 100%. If it's 80%, you take 100%. If it's 50.1%, you take 100%. Okay. Okay, good. Let's go ahead and let's take a look at this one. Assuming I can find my mouse to get in the poll. Okay, guys, we're at about the 2:30 mark. Okay, good. We got everybody participating. That the last couple came in. So good. Everybody got this one right. And I think that you can pretty much see here that you had to have between choice A and B, even have to get is a good start to this question, because we would do what? They sold the machine for 900,000, but they paid what? 1.1. So we reported at what? At its original cost. So you're sitting there, it's either A or B. Maybe I shouldn't put checks next to both of those. Really want to eliminate those two other. And then they're saying, well, what should it be reported at December 31st, year 10, at the end of that first year? Well, the accumulated depreciation should show what? Should show, and at the beginning, it would have showed the 250,000 at the time that the transaction was made. There would have been accumulated depreciation of 250, which they tell me right there. Okay, but I have to take that extra year's worth of depreciation. So it was 1,100,000, right? The what that they originally paid for it, the salvage value was 100,000. So that means I had a depreciable base of $1 million. They tell me that the equipment has what? 20-year life, which we continued with. 20 years means that I have to take an additional what? 50,000 of depreciation, thus bringing the total amount up to 300,000, right? Which is what we all got as the answer here for A. Okay. Okay, good. Taking a look at the consolidated financial statements, guys. Remember, we looked at this earlier. We include 100% of the assets, 100% of the liabilities, 100% of the parents' stockholders' equity. But then, because we only gave 100% of the parents' stockholders' equity, we have to bring in the non-controlling interest. The non-controlling interest, we said, is what? It's like the retained earnings of the non-controlling interest. Okay, that gives us then our total equity. Okay. Then what? Then we would have the income statement, report 100% of the sales, 100% of the expenses. So our net income is everybody's net income, but then we back out the non-controlling interest share of the net income, which is the net income times whatever the non-controlling interest percent is. Okay. We take a look at the consolidated statement of stockholders' equity. Okay. Notice here, guys, what? We have basically all this is the consolidated, and then we report what happened with the non-controlling interest portion separately, right? Okay, so on for the consolidated folks, we report what? We report everything, and then we have that what? The consolidated company is that part that I boxed up here. This is what? This is the non-controlling interest percent, which is siphoned off as a separate, split off as a separate part of the statement of changes in stockholders' equity. Okay, now we're getting there, guys. We still want to talk about statement of cash flows here. Okay, and some key things that I'm going to ask you to flashcard. First, we have what? The period of acquisition. Okay, and the following steps are necessary to prepare a consolidated statement of cash flows in the period of acquisition. The net cash spent or received in the acquisition, usually spent, is reported in the investing section on the statement of cash flows. Okay, so go ahead and flashcard that, but you can see here that they acquired the company for $2,500,000, but there was what? 800,000 of cash that was held by the subsidiary. So really the net cash that was paid on the acquisition was 1.7, and that would be shown on the investing section of the consolidated statement of cash flows. Okay. coming down, the assets and the liabilities of the subsidiary on the acquisition date must be added to the parent's assets and liabilities at the beginning in order to determine the change due to operating, investing, and financing activities. Flashcard that. But just look at this example. A parent company has reported notes payable of $600,000 on January 1st, acquired a subsidiary that had note payable of $250,000. The consolidated balance sheet reported note payable of $750,000. So what happens? The difference there is $100,000, the 6 plus the $250 of account payable that was acquired minus the consolidated balance means there's a cash outflow here, and that would be on long-term debt, which essentially in this case, since it's long-term, would be reported in the financing section on the consolidated statement of cash flows. Okay. Now, subsequent periods are simplified, they tell us, because at that point, then we have full 100% consolidated balance sheet and statement, income statement, where we can go through and prepare a statement of cash flows, analyzing the balance sheet and the income statement like we would for any statement of cash flows. Okay. But there are a couple of things that we want to make sure that we do correctly. And so flashcard these, if we're using the indirect method, or even if we're using the direct method, and we have to reconcile net income to cash provided by operations, we use what? We use the consolidated net income, okay? That consolidated net income number, not the amount that's just attributable to the consolidated entity. We use the total consolidated net income, including both that for controlling and non-controlling interest. And the financing section should only report dividends paid to non-controlling interest. Dividends paid to the parents are not reported. Okay. And then finally, the investing section may report the acquisition of additional subsidiary shares by the parent if the acquisition was done on the open market. Okay, so just flashcard those are kind of subtleties, and something where you might get some extra points if you're actually preparing the statement of cash flows. Okay, now in this next section, guys, they go through a comprehensive example. I do want you to review this. Okay, review for homework. Okay, maybe not a bad idea to watch. I think it's Garrity does a pretty good job going through this whole process. We've looked at the pieces. This is more comprehensive, and you can look at that. If you don't want to watch the video, you can just kind of walk through all the journal entries that they give you, etc., dealing with all the different things that we have talked about. Okay, so it's really a review, and it is comprehensive in nature, so it's pretty helpful in that regard. Okay, now they give you a worksheet and everything else, but obviously with the time that we have available, I'm not going to be able to go through that in detail. But what I want to do is I want to go ahead and have you look at a couple more questions here. We're going to adjourn after we work these questions and then we'll deal with, I guess, the impairment module at the start of class next time. Let me start out here. There's been some email exchange that I've been having since the start of class. They're wanting me to come and do that new CPA exam thing, but there's some debate back and forth because they're saying that I can't do that thing over Zoom. Meanwhile, I don't want to talk to an empty room. And so they're going to kind of have to guarantee me that there's going to be somebody in the room when I come in to do that. So stay tuned is the bottom line on this, guys. I'm sorry for not having a definitive answer as to whether or not I'm going to do that on campus, but typical GGU, we tend to, talk past each other in email until we absolutely have no choice but to, come to a resolution as to how we're going to handle things. So stay tuned. I'll let you know whether or not I'm going to be on campus, whether or not I'm going to do the new CPA exam presentation, on campus, whether or not it'll be available via Zoom or not, because they're saying they don't want to have it available via Zoom. Meanwhile, I'm saying, well, I don't want to come all the way in there, schlep in there early to talk to an empty room and so on. And so we're having that kind of conversation. So we'll figure it out. Okay. And I'll get back to you on that. All right. Okay. With all that, though, let's go ahead and let's look at this question. And this is a really good question. I think you'll really like this question. Okay, we're at 2 minutes. I'm going to give you 3 minutes on this question because it is a little tougher. In fact, I'll give you 4 minutes on this one. It's a little tougher, so I'll give you a little extra time. Although on the exam, never spend more than 3 minutes on a question. I can hear your brains just cranking away on this one. I'll give you, we're coming up on 3 minutes. I'll give you 15 more seconds. Okay, guys, I'm going to go ahead and end the poll here. And okay, tough question. Okay, and this is the kind of question that in my mind gives, you know, consolidations a bad name on the exam because, you know, everybody remembers the horrific questions. Meanwhile, they forget about, well, there's probably a bunch of easier questions that they did okay on. Okay. So again, don't let questions like this freak you out about consolidations on the exam, but let's just go ahead and see. And most of us got this right. The answer here is C, okay? But let's just go ahead and see how we would have done this, okay? Now, first off, we know that the parent's stockholders' equity is going to be part of the consolidated. We know we always have to pick that up, okay? So we got to pick up that 270,000. Of course, we can't get to any of the choices without it, so that's not really earth-shattering. But then we know that we have to go ahead and do what? Make an adjustment and add in the non-controlling interest share of the stockholders' equity. So when we want to calculate the non-controlling interest share, we have to sit here and say, well, look, they paid 120,000 for 80% of the company. Okay, so if it's 120,000 and we divide that by what? 80%, 0.8, we come out with 150,000. And let me write my non-controlling interest over here. Okay, and if the non-controlling interest is what? 20%, then that means that the beginning balance in the non-controlling interest was what? Was 30,000. Okay, but remember, we have to adjust that for the end of year, and it's like the retained earnings. We got the beginning balance. We have to add the net income, subtract any dividends, and that will give us the ending balance, right? Okay, so now we go ahead and we need to calculate the net income. So we start to look at the retained earnings of the now subsidiary. And they tell us that the retained earnings of the subsidiary now, their retained earnings had a beginning balance of 36. It had an ending balance of what? Of 51. They tell us up here that the subsidiary paid dividends of 5. So we have a subtract of 5,000. We have to work up. And we're saying, well, look, if you, and I always like to calculate a subtotal on these, keeps me from making a mistake. If I had 51 and I subtracted 5, I must have had what? I must have had, what is it, 56 sitting there. And I had to add something. What did I add? I added my net income. Therefore, my net income must have been what? 20,000. If my net income was 20,000 and what 20% of that is attributable to the non-controlling interest, that means that I would have added that net income of, what is it, 4,000? And then the problem told me that they paid a $5,000 dividend, $5,000 dividend, 20% goes to non-controlling interest. So I would have subtracted that 1,000 of the dividend. So the ending balance for the non-controlling interest is 33,000. So I now have what? The parents, which always comes forward, plus the non-controlling interest of 33,000 gives me the 303,000. Okay. Now, again, questions like this are the kind of question that gives consolidation, if you will, a bad name on the exam, because this is hard. No doubt this is hard, and the examiners like to give you some tough questions like this. By the way, you get extra points for this kind of question. Okay, I keep saying that a hard point is as easy, an easy point is as valuable as a hard point. That's just counting 1 point. Questions that carry more weight to them do have more point value. Okay, so you want to try to get this right. If you don't, maybe you narrow this down to a couple and move on. Don't spend more than 3 minutes on a question like this, though. Don't do that. Okay. Okay, good. I'll tell you what I want to do. I'm looking at the time and I don't feel like rushing through these last 2 questions. So what we're going to do, I'm going to ask you to look at these last 2 questions on your own, but we will review them as a nice review of what we talked about today at the start of next class. We'll deal with the intangible assets and we'll jump into our chapter 5 material next time. All right, guys, I don't know whether or not I'm going to be on campus for that new CPA exam presentation or not. I'll let you know. I'll post something. I'll email you guys, let you know what's happening with that in case you want to come to that. And then if I'm there, I'm going to be in whatever room Cheryl indicated to us last time. I will obviously be there. I'm not going to rush home to try to do the class from home. I'll just do it in the designated room. But I'll give you information on that new CPA exam presentation. depending on how the powers that be determine where my body needs to be next week when I go through and if I do that presentation. There's just a little tug of war because I don't want to go and talk to an empty room. I'm sorry. I just don't feel like doing it, but we'll see. Okay. Any questions, guys? All right. I will see you next week. Keep up the good work.
Thank you. Have a good night.
Thank you.
Good night.